my name is Nurul Husna binti Hasrulnizam and my matric number is 057060. So our group, which is group 7, got topic of issues in credit scoring application. So in this video, my group are going to explain a bit on what we got from our research regarding this topic. So as a brief explanation from me, actually credit is a common tool or maybe a famous tool that all of people in Malaysia have, I think. Usually people use this card either annually or maybe they use in an emergency situation. But in order to get the credit from bank, they need to achieve and fulfill a little bit of requirement that was set by bank, which is one of it, credit scoring. So credit scoring helps bank to determine whether the application is acceptable or not. So that's all from me. We are going to continue with my group members.
Okay, in this video, our group members will present about the introduction, the research method, some of the issues in credit scoring, such as the information for credit scoring, the reject inference, the better tools that are needed to identify and prevent the discrimination, and the customers that will go to the competitor, and finally the conclusion.
My name is Umi Athirah binti Baharudin. My matric number 056470. So today I want to talk about credit scoring. Okay, credit evaluation is the most crucial process in banks' credit management decision. The process includes collecting, analyzing different credit element and variable to assess the credit decision. Credit scoring is a statistical analysis performed by lenders and financial institutions to determine a person or a small operated business and credit worthiness. Credit scoring is used by the lenders to help decide whether to extend or deny credit. So that's all from me. Thank you.
Research method. Okay, there are 3 types of research method that we use. The first one is internet search, the second one is secondary data, and the third one is researcher review. For internet search, we use the internet to search for article, journal to complete the assignment. Okay, the second one is secondary data, the data that are already available and can be used by anyone beside the researcher, which means it is not collected directly, but rather obtained from published or unpublished sources. The sources can be obtained from scholars, journal, website, and book. Okay, the third one is researcher review. The review will be made based on the information and data that had been stated in the researcher as the last method of study. Also will give an opinion and provide the suggestion to the issue that relate to the topic.
Assalamualaikum, my name is Zaidatul Shakirah binti Shukri. Matrix number is 057048. So I'm going to present about the issue in credit scoring applications. First, information for credit scoring. The traditional 5 Cs of credit has been used in scoring system, which is character, capacity, capital, collateral, and lastly, conditions. Different credit information is needed to determine the risk of various types of credit. Here are some examples of predators that are commonly used. First, resources for information, which is from public credit information companies and also from application forms. Second, classifications and examples of information. We can see that there has data from reports, data from credit reports, security information, financial status, employment status, residential information, family information, and the last one is basic personal information. This information typically contains both the specifics in the applicant's application form and the data kept by credit information agency. In several companies, a large amount of data about past customer and their subsequent output is saved, and this data is used to build credit scoring models. Other than that, the data for business credit customer is more complex and includes a wide range of information. So, in this slide, there are some examples that we can see. Business reports issued by public credit information firms may provide the basic information. These reports are available for a low information fee and can be accessed through the internet. Basic information such as address, legal forms, and dates of foundation are included in the company reports, as well as information on sales, income, and the overall business condition of the list. The credit applications come from a wide range of players, including those that are unfamiliar to the credit officers. Another information that is considered to be significant predictors of small business loan repayment success is information on the firm's owner or principals. Small business owners' personal credit history are highly predictive of their company's loan repayment prospect. Credit companies that offer confidential credit information may be used to obtain personal information. Business scoring models are often built on the basis of financial data. The financial statement, income statement, and cash flow statement also provide crucial financial data. Many academic studies have established bankruptcy models based primarily on financial translation. Information about the industrial sector economic condition has also been factored into scoring model. So the next issue is about the reject inference. Reject inference is a method for improving the quality of a credit scorecard by incorporating data from rejected loan applications. Bias can result if a credit scorecard model is built only on accepts and does not account for applications rejected because of past denials for credit or a non-default status. Reject inference is only necessary for scorecards when there is no performance information for rejected applications. Second, you can infer the performance of reject and include in the credit scoring model to remedy this bias. Last, there is other missing data problems such as insurance policy approval, staff selection, and medical diagnosis. Hand and Henley study the various methods of reject inference and come to the conclusion that accurate reject inference is unlikely. The assumptions made about the change made by reject inference are dependent on change or additional details such as accurate assumption or other ad hoc adjustment. Another option is to consider all or some of the applicants who will usually be rejected for a brief amount of time and use them as a sample to develop better scoring models. A third alternative is to get details on rejected applicants from other credit providers that they approve them.
Okay, we move to the next point in applying credit scoring, which is better tools are need to identify and prevent discrimination. As we know, in applying a loan or financing, bank or lender will check our financial history first. The information that we consider such as occupation, education background, payment for their borrowings history. Okay. Some of lenders will go to deeper information in applying credit scoring that includes race, genders. This information will lead to discrimination. Okay, we move to the next point, which is customer will go to competitor. In applying a loan or some financing, customer will choose to the bank that offer the best service. Let's say if their loans will be rejected by a bank, customer will go to another bank. They think after being rejected from a bank, they will be not rejected by another bank. Before bank approve their loan application, bank will check their credit history and get their credit scoring result. So, customer must improve first their credit scoring and before applying a loan.
In the summary, it is easier for a person with a good credit score compared to a person with less best than credit score. A person with a good education and occupation and maybe their media social are more highly affect their credit score rating. In the other hand, a good reputation will lead you to a good result for credit score rating. As a customers, we will probably choose to go to the bank that offers the best services. Basically, all the banks have the same method in approving loan by calculating customer credit scoring. It is crucial for an individual to have the best credit scoring or the best credit history, since it might lead you to an approve for a loan. Repaying your loan by the time given or on time is important because it will affect your credit history. So that you have and must pay your loan on time to avoid any misunderstanding between the bank and the financial institution. There is so much benefits for customers that pay off their loans by the time given. Those who were previously accepted have a higher default rate compared to those who were rejected. In the conclusion, it is important for a person or an individual to have a good background in credit scoring so that we can easily get a loan from any financial institution and bank.